the higher the chance that you could have a substantial negative rate of return. Actually, there's also a substantial chance you could have a sizable positive return too. So what's good news for the bond investor? If I've got the 2-year bond or the 30-year bond, well, good news for me is if interest rates, if they actually, in terms of our bond price, we always want the price to go up. So for us, we'd like the interest rates to go down. So good news in the bond market is where interest rates go lower. This will cause a rally, the so-called rally in the bond market. So if I'm holding a bond, a longer term bond, I very much like interest rates to decrease because this will increase the investment value of my bond. So this is a simple exercise in bond price dynamics. When we talk about duration, we'll talk about how this differs for different maturities and for different types of bonds, whether a coupon bond or a zero coupon bond. But the essence of the bond price dynamic is interest rates up, bond prices down, interest rates down, bond prices up. The so-called first derivative of the bond price with respect to the interest rate is negative. And graphically, you'll see in the lecture note graphs of the bond price against interest rates. And that sort of graph is a curve. And the curve is downward sloping. So as interest rates increase, the bond price is decreasing. So in order to look at this in great detail, we have to go through some of the quantitative aspects of bond prices. But it's always the case, as interest rates increase, that the bonds must lose value.